let's move on to the business life cycle. This is an important graph for you to understand when a company is moving into position, or it is already in position, or it is in a position whereby the industry is maturing, or perhaps where the industry is going right down. Yes, so remember the days of Blockbuster? It will have gone through all of this. Yes, a whole lot of companies have gone through all of these phases. So here we have a graph. This graph has sales and profit, and this has time, which could be in years. So what normally happens is that when the company enters the first phase, it is called the startup phase. That's when people put together their equity and try to get things going. So then they are not making any profit. As you can see in the green line, this is negative. So they are not making any profit. And then they are looking for investors and pushing forward. So they enter the next phase, whereby they found investors. They now have their business plan. They have how they are going to get moving, and they are actually selling products. So here you have sales could be up to 100% per year, so sales is just multiplying every year. So you have, for instance, they sell this year $10 million, next year they are selling $25 million, and the year after they are selling $50 million. This is what you call the emerging growth phase. Then we move on to the established growth phase. Established growth phase is where competitors are now trying to come in. They are trying to slow you down. Your products are beginning to saturate. They are beginning to get into the market. Your revenue is going roughly 25% year on year, and things like that. So that is where you experience the established growth phase. Then your product is now in the market, and competitors are trying to steal your cookie away from you. There you are entering the maturing phase. So about here, your revenue, your profit, they grow around approximately 10% or less. They go approximately 10% or less. So that is the maturing phase. When you get into the declining phase, that is where you now find it very difficult for people to take your products. Your growth is not increasing, but rather you are declining, and then you are now having lots of depreciation. You are just taking cash from through depreciation, and you are not spending you're not spending more to increase your property, plants and equipment. So now it's like you are winding down the business. So in this phase, your revenue is going right down. So that is the declining phase. All of this is mirrored also by the profit. So the profit kind of takes the same shape, taking the lead from the sales and mirroring it right down. So that is that for this particular case. These phases can be altered, can be delayed. So some companies are very good at elongating this emerging growth and established growth, as well as their maturing phases. So what they do is they keep on researching, spending a lot to keep pushing new products, extending the usefulness of their product, and finding new ways for which their products can be used, evolving, to just keep evolving. Some companies are that good. So they just keep pushing the envelope to avoid getting into the maturing phase and declining phase. So whenever their product is becoming outdated, they bring in a new one to help push out new revenue streams, so that they can keep earning and keep getting more sales and keep going, so that at the end of the day, these two phases don't really come. So that is key. The business life cycle is where we are going to end today. Next time, I'll be speaking about the price ratios and how they evolve as well. Thank you and have a lovely day. Bye.